All right, macro shock investors, welcome back. Dave here, and today we've got a macro event unfolding that could either be a temporary blip on the radar or a genuine market mover. The question on everyone's mind is, will the looming government shutdown send our portfolios into a tailspin, or is this just another political drama the market will shrug off? Let's dive straight into what's happening. As of today, September 27, 2025, the U.S. federal government is staring down a funding deadline of midnight, September 30th. If Congress fails to act, we're heading into a government shutdown on October 1st. The gridlock is intense. Congress has so far failed to pass any of the 12 required annual appropriations bills or even a stopgap continuing resolution to keep the government funded for fiscal year 2026. The House passed its funding bill, but the Senate quickly rejected it, with many Democrats opposing its exclusion of provisions like extensions for Affordable Care Act subsidies. Adding to the gravity, the White House's Office of Management and Budget has taken an unprecedented step, instructing federal agencies to prepare not just for furloughs, but for potential reduction in force notices, essentially mass layoffs for employees in programs deemed non-essential or not aligned with presidential priorities. This is a significant departure from previous shutdowns where back pay for furloughed federal workers was generally guaranteed. Mainstream media outlets like CBS News, JP Morgan, and Politico are reporting on the escalating risk, emphasizing that this shutdown could have a greater impact than past instances due to deep political divisions, a vulnerable economy, and the White House's hardline stance. Economists are warning that each week of a shutdown could cost the U.S. economy approximately $7 billion. This isn't your grandfather's government shutdown. The confluence of factors makes this one particularly tricky. Let's break down the potential future scenarios and what they could mean for your investments. Scenario 1. Short-lived shutdown, 1 to 2 weeks, 50% probability. Historically, most government shutdowns have been brief, lasting only a few days, and markets have tended to rebound quickly once a resolution is reached. We'd likely see an initial dip and increased volatility in the S&P 500 and NASDAQ as headlines hit. However, if history is any guide, markets tend to look past short-term disruptions. For instance, during previous short shutdowns, the S&P 500's average return has been largely flat or even slightly positive. Any losses would likely be recovered swiftly upon a resolution. Specific market sectors: government contractors, defense, IT services. Companies like Lockheed Martin, LMT, or Booz Allen Hamilton might experience temporary delays in contract payments, but no significant long-term revenue hits. Projects deemed essential would continue. Travel and leisure: minor impact. We might see slight drops in airline stocks, e.g. Delta Airlines, DAL, United Airlines, UAL, or hotel chains, e.g. Marriott International, MAR, due to reduced federal travel, but this would be transient. TSA agents would still work, albeit without immediate pay, so airports would remain open. Consumer discretionary: federal workers who are furloughed are typically guaranteed back pay. So, while there might be a very temporary tightening of consumer spending in areas with high concentrations of federal employees, it wouldn't likely cause a significant ripple across the broad retail sector, e.g. Amazon, AMZN, Walmart, WMT. Scenario 2. Prolonged shutdown, 3+ weeks, 40% probability. This is where the real concerns begin. With the current political divisions and the White House's layoff directive, a longer shutdown is a very real possibility. A prolonged shutdown would have a far more significant negative impact. We saw this during the 35-day shutdown from December 2018 to January 2019, where the S&P 500 corrected by 13% in the 12 days preceding it, and the Congressional Budget Office estimated a permanent loss of $3 billion from GDP. Investor and consumer confidence would be severely eroded. Critically, federal agencies that collect key economic data, such as employment and inflation reports, CPI, would be disrupted, leaving the Federal Reserve flying blind in its monetary policy decisions. This information vacuum could lead to increased market uncertainty and volatility. Specific market sectors: Financials, investment banks, and technology/biotech IPO-dependent firms. The IPO market could freeze entirely without SEC approvals, significantly dampening activity for investment banks like Goldman Sachs $GS, and JP Morgan Chase $JPM. High-growth tech and biotech companies planning to go public would face costly delays. The inability of financial regulators like the SEC and CFTC to function fully could also undermine market integrity and increase vulnerability to illicit activities. Government contractors, defense. Companies heavily reliant on federal contracts, e.g. Northrop Grumman $NOC, Raytheon Technologies $RTX, would face severe and prolonged payment disruptions, leading to substantial revenue hits and potential project delays. Federal contractors are not guaranteed back pay. Travel and leisure. The impact would be much more pronounced. Longer airport security lines and potential disruptions, TSA working without pay, national park closures, and general reduced consumer and business travel would hurt airline, hotel, and related travel stocks more significantly. Consumer discretionary. With federal workers facing potential layoffs or extended periods without pay, a sharp contraction in consumer spending would ripple through the economy, negatively impacting broad retail, automotive, and hospitality sectors. Healthcare. Programs like Medicare telehealth flexibilities and community health center funding are set to expire if a funding bill doesn't pass. This could add pressure to healthcare providers and related stocks. Scenario 3. Escalation and credit downgrade, low probability, 10%. While less likely, the deep political divisions and unprecedented layoff threats carry a small but non-zero risk of escalating into a broader crisis of confidence. This would be a catastrophic scenario. We could see a severe and widespread market sell-off far beyond a typical correction. There would be a massive flight to safe haven assets like gold, but even the perceived safety of U.S. Treasury bonds could be called into question, especially if international confidence in U.S. governance erodes. This could lead to an increase in borrowing costs for the U.S. and potentially even impact the dollar's status as the global reserve currency. This would signify unprecedented economic uncertainty. Specific market sectors. A credit downgrade or severe crisis would trigger a broad market correction, with virtually all sectors and stocks experiencing significant declines. No sector would be immune, though highly leveraged companies or those with weaker balance sheets would be hit hardest. All right, so what's Dave doing? Given the elevated stakes this time around, with the unprecedented layoff threats and an economy already facing headwinds, I'm moving into a highly cautious watch-and-wait posture. This isn't the time for aggressive new positions. I'm certainly not selling everything into a panic, but I am not buying the dip either, at least not yet. The uncertainty around the length and severity of this shutdown, coupled with the potential for delayed economic data, means clarity is at a premium. Now, let's bring in the technicals, because they often tell us where the market is really trying to go, regardless of the headlines. Looking at the SPY, our bellwether ETF for the S&P 500, it's currently in an uptrend. However, it's trading in a consolidation phase. We've been bouncing between 660 and 667, just waiting for a catalyst. This government shutdown is precisely the kind of catalyst the market is looking for. What am I watching for? A breakout above 667 would signal renewed bullish momentum, potentially pushing us towards the next resistance at 677. This would suggest the market is shrugging off the shutdown or anticipating a quick resolution. Conversely, a breakdown below 660 would be a significant bearish signal, indicating that the market is taking this shutdown very seriously, with a potential move down to 645. This lower level would represent a more pronounced correction, reflecting deeper concerns about the economic impact. My strategy right now is to let the market show its hand. I'm keeping a close eye on those key technical levels, especially 660 and 667, and watching for any legislative developments out of Washington. What do you think about this looming shutdown? Are you bullish, bearish, or staying on the sidelines? Let me know your thoughts and your strategies in the comments below. And if you're getting value from this analysis, do me a favor. Hit that like button and subscribe to Macro Shock for more sharp insights into what's moving your money. Remember, this is not financial advice, just my analysis and perspective as a market commentator. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. Your capital is at risk.